All right. Hi, everyone. So good to see such wonderful faces. We are very excited to kick off our Stablecoin Builder series. This is episode 12. Feel free to ask any questions in the chat. Our wonderful panelists, as well as our in-chat moderator, will be able to share those, and we'll review that at the end. So my name is Stacey-Ann Pearson. I work with Utila, APAC Director. And today we have an awesome session prepared for you, focusing on RWA tokenization, building the on-chain asset economy. So we've got a stacked panel tonight. Very quickly going through the agenda, we'll do some welcome and introduction. We'll talk a couple of topics. We'll leave some time for audience Q&A, and then we'll move to the closing. All right. So as I mentioned, the Builder series, these are monthly webinars that we host for founders, entrepreneurs, and operators building products in the stablecoin space. We cover topics at every stage, from idea to funding to shipping. So we run these sessions for the stablecoin economy and ecosystem by tackling infrastructure and real issues. So today we are joined with 4 panelists. Each will have 30 seconds to do your elevator pitch. Who are you and what are you working on? And then obviously as we go into the questions, we'll have more details. Just a very brief introduction to Utila. Utila is a fast-growing institutional stablecoin and digital asset operations platform, providing secure custody, treasury, payments, trading, and tokenization infrastructure, working with our customers and partners as well, serving 300 plus fintechs, banks, and crypto native firms worldwide, built on military-grade MPC key security and multi-chain support across EVM and non-EVMs. Last month, we did celebrate our milestone. We passed $25 billion USD in monthly transactions processing, or monthly transaction volumes. So we are very excited to be growing fast and working with amazing players. All right, so over to our speaker introductions. What are you doing? Who are you? 30 seconds. Let's start with Peter Chung, and then we'll go to Aaron, Gabriel, and then Sean.
Okay, yeah, thank you, Stacey. So my name is Peter Chung. I work at Presto. My role is the head of research, which means that I'm in charge of collecting market intelligence that is relevant for our business. Our primary business is we are a market maker. We're also a DeFi curator. And also OTC trading service provider. We were founded in 2014 in Singapore. Initially started out as a quant trading, prop trading desk, trading TradFi assets, but 2017 expanded into crypto. And right now our activity is about 50-50 between TradFi assets and then the crypto or digital assets. We have offices in Singapore, Seoul, Shanghai, and Hong Kong. Myself is based in Hong Kong. Very much committed to tokenization trend. Yeah, glad to be here to talk about what RWA is all about.
Nice. Thank you, Peter. Aaron, over to you.
Yes, thank you. Great to meet everyone. I'm Aaron. Every time I say that, I feel like I need to add that I'm an alcoholic. But since it's a very pristine crowd that we have,
professional,
enterprise grade, institutional grade, as we say. I'm the founder and CEO of Libeara. We are a regulated tokenization platform in Singapore. We to incubated within the Standard Chartered Group's digital asset ecosystem. To date, we've been partners with Wellington, China Asset Management out of Hong Kong, and a number of other fund managers to bring more tried and tested Web2 strategies, I like to say, into Web3 form to broaden access to strategies that people need to have and as part of their investment ecosystem. And this is what we're here to solve.
Amazing. Thank you, Aaron, and congratulations on your recent raise.
Thank you as well. Thank you.
All right. Over to you, Gabriel.
Hey guys, Gabe here from Securitize. Been in this space since 2013, but as of late, I've been very much heads down in the RWA space, leading DeFi growth for Securitize. For those who aren't familiar, Securitize itself is a leading digital asset securities platform. We essentially bring traditional assets such as private equity, venture capital, real estate, public equities, funds, money market funds, these types of assets on chain in a fully regulated and compliant fashion. So Securitize itself is a pretty diversified business. It's also a SEC registered transfer agent and broker dealer. And we essentially manage the full life cycle of digital securities via the DS protocol. And fully on chain. So we have pretty big partners like BlackRock, Morgan Stanley, KKR, BNY Mellon, who have brought assets on chain. And my role specifically is to create use cases out of these assets because what's the point of putting stuff on chain if we don't do anything with it, right? So yeah, that's all for me.
Thank you, Gabe. Over to you, Sean.
Very nice to meet you, everyone. Thanks for joining, and also a great pleasure to have this opportunity, Stacey. And also, they were very excited to work with Utila going forward as well. My name is Sean Chung. I'm the VP of Global Business Development at R25. R25 is a vault infrastructure. It's an institutional-grade infrastructure protocol for focusing more on the digital and real-world assets. And then we kind of focus on not only RWAs, but we do want to emphasize on the real-fi nature of the industry, because I know, as you all know, we're moving at an accelerated pace to combining all the traditional financial sector into the blockchain as we speak. So at R25, again, it's a vault infrastructure that we develop a secure and modular smart contract-based vaults. We enable asset managers and institutions and Web3 allocators to package their off-chain assets, financial assets, from private credits, trade finance, treasuries, and equities, tokenized stocks and bonds, to bring them on chain. So we want to maintain our compliant nature we want to focus heavily on that, and of course on the compliancy and also security and reliability. And we want to make sure that individuals, retail institutions, high net worth individuals, like anybody who's interested in the industry, to get maximum global liquidity access seamlessly. Yes, happy to join the panel today.
Amazing. Thank you for the fantastic introductions, gentlemen. I personally know that you are all working on fantastic products, so excited to jump into the discussion where you can share your insights about the broader industry, as well as weave in stories about the products you're working on, the launches, and the lessons that you've learned throughout. So we'll kick it off really interestingly. You have been in the space for many years, so you also know that RWA as a concept isn't new, but it seems that RWA tokenization is gaining a lot of momentum right now. So Aaron, maybe you can share what has changed over the last 12 to 18 months.
Wow, 12 to 18 months seems like an eternity. I think we've, 12 months ago, if you look at crypto market cap in general, obviously we've seen some rebound over the last couple of weeks, but just roughly speaking, I think we've kind of halved. We've seen though that during that movement, stablecoin, usage continues to be strong, and potentially technically kind of growing in that sense. So what we have seen is that the impetus to hold stablecoins continues to be strong. And that means that people will want to manage stablecoin wealth in stablecoins without necessarily having to off-ramp everything that they get to create generate returns from the holdings. In that sense, I think that's what we've seen drive general demand over the past 12 months. But look, I still think the denominator is still very, very small. I come from 21 years in investment banking, specializing in debt capital markets, where I helped issuers in the region raise over $180 billion worth of bonds. And compared to that, RWA is nothing, right? So I think there's this drop in the bucket. So there's still a lot of room to grow, and I think bringing issuers into the space is important. What Gabriel mentioned about creating utility out of it, even more important. Broadening accessibility, as Sean mentioned, through Vault infrastructure, very interesting as well. So yeah, I mean, we would love to see more integration, and I think while we talk about institutional, I think I always want to try and go back to basics in terms of what is it that tokenization, or in fact the blockchain revolution has brought. It's really brought together the ability for I don't like to use the word, but for democratization of access into things that were more difficult to access. Democratization and accessibility doesn't mean eligibility, but to those that are eligible, having accessibility more broadly is important. And solving for that is I think, quite important. There's a lot of stuff that we still need to do. I think while crypto has had its troubles over the past 12 months, I think a lot of focus has moved into trying to get more institutions onto, tokenization rails. But I think, ultimately we're trying to serve the individual investor. And I think I really want us not to forget that.
Yeah, that's fantastic. And thanks for sharing that. Going off of something you mentioned about still bringing in the institutions while also recognizing that we are serving individuals who are making these decisions about investments. Maybe we can get Peter to weigh in, especially since you have also, your company has also gone through a transition. Why are financial institutions paying attention to RWA tokenization now?
Yeah, I guess the main thing is actually, to Aaron's credit, I think what has happened with the stablecoin is playing a big role, especially if you recall, 12 months ago, we passed a legislation called Genius Act. Now, it hasn't gone into effect yet. It's going to go into effect probably, in the second half, or maybe no later than January 2027. So that's only a few months away. And what that's going to do is allow many of the, the mainstream traditional companies to be able to, utilize stablecoins to their benefit. And, that I think many companies are actually preparing for that era to arrive. And that's going to, translate into many new services that we haven't experienced before. But one of which is actually easy access to various type of the assets, and that's gonna that's gonna be more easily tradable when these assets are tokenized and put on blockchain. So I think Genius Act has, I think, is actually definitely played a role here for financial firms to pay more attention to tokenization space. Another is, I think, is with this under Trump administration, we have a lot more crypto-friendly regulators, and the SEC as a chair, Paul Atkinson has publicly I guess talked about the Project Crypto around exactly a year ago, this time last year, where basically what the main message was that he's willing to, he thinks that blockchain is a tool to upgrade the financial system, and basically he basically said that he will remove all regulatory bottlenecks to clear the way for the more blockchain adoption in the mainstream the traditional financial infrastructure. So I think that has given a green light for many of the financial firms to actually look at this technology and see what it can do for their services. And those forward-looking financial firms are actively embracing the technology.
Right. No, that's fantastic. And it's something we're hearing across the industry from experts, right? That one movement around Genius Act also sent ripple waves throughout regulators globally. You saw a bit more openness towards considering their own localized versions of stablecoin regulation or mandates that were previously on pause. And so, this is something that is really valuable for you to mention as well. You also spoke about the asset classes and looking at the experimentation. So we'd love to move over to then, where is tokenization creating real value, right? There's a lot of buzzwords in the industry. So wanted to give Sean and Gabriel a chance, because they are building out and have already launched real products that have subscriptions, hundreds of millions of dollars of subscriptions. So maybe I'll start with Sean. Where do you see the industry experimenting with tokenization?
It's a very good question. I think it's a question that we need to continuously ask ourselves to see where we're heading going forward. I think everybody might have a little bit of a different opinion, but at the same time, my thoughts are in terms of what we're seeing in terms of immediate production grade value today. What we're seeing in the short term, I would say we see a lot of interest in the high yield assets, sort of like private credit. People are trying to tokenize some of the trade receivables because these yields are a little bit higher than the base money market funds, and also some of the corporate bonds and so on. But just taking an example of one of the assets that we launched in partnership with a risk curator called Axel is the Axel Prime Credit. It's providing like a 14.3% APY, which is a little bit higher than the traditional standard, I guess, but it's backed by highly diversified micro consumer loans across an emerging market. So this is a business that has been ongoing for decades, and at the same time, this was an interesting asset that we could kind of tokenize. And at the same time, I would say doing like so these type of assets, I guess, for example, like for us, we were able to collaborate with some of the distribution channels to bring in, I think it was around $45 million. Aaron, compared to the industry that you've been in, this would be minuscule, but at the same time, but this is something that we're continuing to experiment, and we're seeing millions draw in. I think this is just the beginning of an era of a heavy inflow that we will continue to see going forward within several years to maybe a decade, I guess. So, so this is where we're seeing actual assets being tokenized and providing actual value to the deposits. So this is somewhere that we're seeing, and at the same time, as we're seeing a lot of interest, as you've seen with like SpaceX, and we're seeing more anticipation with like Anthropic and Revolut and you name it. So this is like the area where pre-IPO equities, or maybe going into private real estate, that's could be the area that we might see a little bit of interest, but open to debate, us.
I love that. And, I think some of the positive signals is that we have large fintech unicorns that are investing and entering the space, as well as traditional financial institutions who are supporting partners in order to bring these products to life. So moving over, from that to Gabriel, who is working at Securitize, which asset classes are seeing the strongest traction? You guys work with a wide range of traditional asset management firms. So would love to hear sort of what trends you guys are seeing across the different asset classes.
Yeah, for sure. Thanks, Stacey. I think if we look at the numbers today, it's quite obvious like the majority of trading volume or demand or institutional demand is running through things like US Treasury bills, especially for more long-term passive kind of holders, I would say. So we've seen a lot of demand coming from players like foundations, blockchain foundations, these types of funds where they typically just want to hold the underlying asset, maybe in an that's managed by a professional, without really caring about doing it themselves.
Right.
We've seen a lot of demand. I think we have like in the industry now we have like $15+ billion worth of like treasury bills, and it's been growing throughout the bear markets. So it's really like I see it as a way for people on chain to hedge the market volatility. It's really like a safe haven, right? Where people, let's say if like crypto isn't doing so well, Bitcoin is down, this is where they can really generate that yield that is uncorrelated with the general crypto markets.
Okay.
I think beyond that, the fastest moving one is definitely equities. We've seen a lot of tokenized stocks come on chain, be it native or in like a wrapper SPV format. I think that there's like 2.5 billion right now that we've seen going through various tokenization platforms as well. And I think it's really clear, especially in this like regulatory environment where people have the free will to experiment with these types of assets without getting into like regulatory scrutiny. It's quite a big contrast versus a couple of years back where we had the US, the previous US administration, which was, albeit very hostile towards these types of players. So now we're seeing things really open up and a lot of interest driving through things like equities. And I think just a derivative of like equities would definitely be things like perpetuals. I think that's a very interesting space right now, especially with protocols like Hyperliquid, Lighter, these types of protocols where while they're not fully compliant to date, I think they provide universal access to a lot of users who still operate in like a permissionless world, right? So I think that's really interesting to see.
Got it. No, thanks for sharing that. And, it ties back to what Aaron had mentioned before about having the access and the eligibility to these different products as enterprises, as individuals are considering how can they get access to, better yield products, as Sean mentioned, higher liquidity, fitting their use cases. One of the interesting things is, as Aaron previously mentioned, it was aimed at democratization, but we are seeing that there are some trends around aggregation, towards companies that typically already have access to these traditional assets in traditional means. So maybe we can focus on, when companies are building production-ready RWA infrastructure, talk about what was expected versus what is reality. So maybe Aaron, we could start with, what operational challenges appear after launching your RWA infrastructure.
Yeah, no, it's It's a topic that keeps me out at night in terms of just kind of looking at things from a utopian perspective versus a I gotta eat to survive perspective, right? So
That's right.
it's like what good are you if you can't, you gotta, as we say, put your oxygen mask first before you
That's
help
right.
others, right?
Help
So
others. That's right.
first you gotta survive. But what I want, a couple of things that I'm seeing as a trend is two things, and again, I come from TradFi, right? So I'm not a DeFi native. I'm just trying to learn new tricks here. But if you think
I was just going to say, we have the full range, TradFi in a suit and DeFi pseudo-anonymous.
Perfect. Exactly. But I mean, there are two things that worry me. I think first is around the over-dollarization or the US-centric nature of, I mean, look at us here, like, you have all we're talking about is genius, we're talking about Trump, dollars, we're talking about US Treasuries Onchain. Again, not many people are aware, but the first product that Libeara put out was a Singapore dollar government bond fund, which got a AA rating from Moody's, the first tokenized fund to be rated by Moody's.
Nice.
But there was zero demand. Right. They're like, Sing dollars? Who wants Sing dollars? And I'm like, you buy ETH. You can buy Sing dollars. No. We want US dollars, which is why we went and, partnered with Wellington for the Ultra. But the idea is that the over-dollarization or the concentration of stuff into the US is a problem. I think, and especially when we have, markets where, it's driven by trends rather than fundamentals. I think people end up chasing what other people chase, and then you become the utopia of Yuval Harari, where we're talking about monoculture with everyone in the same culture, right? So I mean, that's one concern. The other concern is also what I like to call the re-intermediation, right? So I mean, again, going back to first principles, this was supposed to make more direct access. I mean, the reason why I founded Libeara was to make government bonds more accessible by its citizens, which should rightfully be the case. But then there are too many intermediaries in between, and it costs an exorbitant amount for you to buy your own, for you to lend your own government bond, money, right? So which doesn't make sense. But then the reality of it is that now we have blockchain companies saying, well, no, you know what? You don't need to go to banks. Don't go to securities companies. But we're gonna be, helping you out because we know how to do this. So we're like, is that right? And then you have kind of the Robin Hoods of the world saying that, well, no. We're actually already brokers, but we're now going to use blockchain, and then it's going to be better. So then it's kind of the efficiency game, right? So is it really efficiency that we want? Is it access that we want? Is it re-intermediation? Is it dollarization? Again, I've definitely not answered your question, but these are the things that
so you moved from
myself.
You moved from operational challenges to existential challenges that you are considering.
Correct.
Okay,
but those are all kind of interlinked in the sense, right?
Right.
The operational aspects of not being able to remove intermediaries, the operational aspect of it, of things that, especially in crypto, being denominated in dollars and therefore dollars being predominant. The fact that you can't remove the fiat leg completely because not everything exists in fiat. We talked about 24/7, but dude, someone's making markets and taking your money off of you to settle something over the weekend. It's not 24/7, right? So
no, that's fair.
These are things that, again, they're all interlinked.
Yeah, no, that's absolutely fair. And, something that you mentioned, which is around, the mediation between the so-called 24/7 crypto markets interacting with the traditional fiat market and the fiat rails and the existing infrastructure, and the two need to be able to interoperate. And so maybe a good segue is, to chat with Peter around which infrastructure decisions matter most then, right? If you're trying to launch this RWA ready infrastructure, but still having to operate within the limitations of existing railways, what do you focus on first?
Yeah, I mean that's a very good question, and I don't know if there's a answer that will satisfy everybody, but
everyone, yeah.
I think yeah. But I mean, I feel like when you look at how the industry has evolved over the years, the venue where you can exchange one value for another is actually a very critical component. And I think there's a reason why, if you look around the industry and how it has evolved over the years, it was always trading related utility that gained traction very, very quickly, either in a centralized space or decentralized space. And when you think about why that's the case, it is because what blockchain enables is very efficient the liquidity pooling and aggregation. And what that enables is, I mean, it enables a lot of things, but one of the first things that enables is ability to exchange a large amount of value for another. And so I feel like in order for RWA to bring benefits that we all hope for, I think you need to have trading venue first. Because then what it enables is, what comes after that is, okay, because it's easy to trade and easy to convert into cash or its cash equivalent, it becomes, its attractiveness as a collateral increases. And then that brings efficiency to that asset. So, if you are looking for a world where RWA becomes a more useful thing in this world, I think that's the kind of the sequence that you need to have. You need to have a trading venue first, where there's lots of liquidity, and then you can then have a platform where you can use these RWA as a collateral, and you can you can borrow against. And so I think I feel like a trading venue is one of the most important components.
No, I love that. And my goodness, every product in the world, I think, wants liquidity and utility. So it's a very fair call out here. Maybe we'll turn to Sean, right? Because you are operating within a corporate venture, I guess, that has a parent with access to lots of liquidity and lots of venues. So seeing that you might have had to build from scratch, right, without all of that support, what lessons have you learned from having this production deployments, building from scratch?
Yes, there's so many things to touch upon, but Aaron has kind of given us like a really good macroeconomic framework on like the bottlenecks and what we have to foresee. And then Peter, in terms of market dynamics, I think you touched upon a really critical aspect. For me, just as like the actual production ready operational aspects, there are many things that we learned our lessons from. One of them is, like, I really wanted to emphasize on this session, is the enterprise key and policy custody, I guess, because like when you reach out to the retail, like it's pretty much very straightforward. People need to learn how to use like the UI. Some of them are very user friendly. Some of them are very engineer focused, coding based, but somehow people manage to do it. Once you hit enterprise, it's a different scale and different level of sophistication. You can't have like a CFO of an enterprise run around with a private key and make sure it's secure. You need like a standardized platform. I think that's when Utila kicks in, meaning that you need to create an atmosphere, an environment where it is secure enough, compliant enough for the enterprise space to walk into these type of opportunities.
Right.
So if you really want to target institutional allocators for these types of RWA opportunities, for them to look into these assets and have a chance to make their deposits, you need to make sure that you need to learn that they can't really interact with raw private keys. You can't have like fragmented Web3 interfaces, and they need a standardized platform. That's when I think Utila has the MPC workspaces, very enterprise friendly. They have the policy gating, role-based approvals, and these features are critical in allowing us to step into the institutional space to allow them to freely access the opportunities that you have prepared for them.
Right.
Another item that I wanted to focus in is, I would say, Oracle aspect, which is critical. It's really different from the Web2 space where you have an information provider. Here in the blockchain space, it's we have a concept of decentralization. And we need to make sure that, number one, we need to make sure, for example, all different types of assets, there's always net asset value. We need to make sure that on a real-time basis, the net asset value is reflected precisely as is. And that's when we need to make sure these infrastructure providers are in place. These data are provided on a real-time basis accurately. And also, because it's an off-chain asset, we need proof of reserves, and we need to make sure that on a regular basis, these values and also the types of assets are reported correctly. That's when we see a lot of institutional adoption.
Yeah, no, that's so fantastic. And, given your experience first working with retail and now working with enterprises, I think these two components are really critical in terms of protecting the enterprise and its employees, as well as the ability to essentially have proof of trust that these products, that are new and that are being tokenized, are trustworthy and essentially excuse my language, but not a scam, right? Like, I hate to use that word anywhere near Web3 or digital assets, but unfortunately, we do still have some bad actors in the industry, as with any new technology. So, Gabriel, you've heard different perspectives along the journey of, what are the challenges? How do you keep and build production-ready infrastructure? Given that you work with the DeFi side of this equation, maybe you can share, where do some of the projects get stuck?
Yeah, for sure. I think that's a very good question. I think at the end of the day, we're going to see a lot more issuers and tokenization platforms come on board. And ultimately, it will not be the strengths of the platforms wouldn't be the tech anymore. It will be more of like the reputation of the companies, the reputation of the issuers. It will be the moat that you've created via what use cases you've made with this product.
Yeah.
And I think that's where we really try to find differentiation versus the rest of the crowd, right?
Yeah.
Because if I think putting an asset on chain, once you've gone through most of like the technical work, it's relatively straightforward. They exist as representations of assets that predominantly exist off chain.
Right.
For things like money market funds, it's a lot easier than things like real estate, obviously. But I think where the superpower is, or where a lot of projects get stuck, really is creating the use case or utility of why this asset exists on chain in the first place. What can investors do with it?
Yeah.
So I've spent the past, I would say, 6 to 8 months talking to like DeFi protocols, getting our assets like BIDL, VBIL, US Treasury funds, and also our new products like private credit, ACRED with Apollo, and also the latest fund that we've just launched with Neuberger called HINC. It's a high income corporate bond fund. Getting these assets into protocols like Aave Horizon, Euler, Morpho, these types of blue chip DeFi protocols where you can effectively collateralize your position and then use that to borrow stablecoins, run some kind of carry trade with it, potentially a looping trade with it as well. So I think that's really the interesting part, right? That you can't really get ahead with just tech alone. It's more of like a go-to-market kind of breakthrough, right? So I think all in all, it's eventually you will reach a point where everyone has very similar tech, and what differentiates each other is really the moat that we've built with partnerships and liquidity and utility.
Oh boy, it sounds like all new technologies are facing the same problem, right? AI founders are having the same issue, right? Tech is now ubiquitous. So it's about, just like you mentioned, right? The utility, the distribution, and the ability to have trusted product and trusted issuer. So thanks so much for sharing that. We do have a question, but we'll address the question during the Q&A. And that question is asked quite a bit. Okay, so moving to the piece around potential, right? What needs to happen before RWA reaches mainstream adoption? So we'll come back to Aaron, because you did mention about why are we still talking about Genius Act when there are other regions in the world. So the question is regulation globally still the biggest challenge today to RWA being mainstream?
It's a great question and something that I think pops up quite a bit. And while we do, I mean, obviously, crypto started, globally from day one because it was kind of borderless from day one. When you venture into the realm of what I like to call tokenized, regulated assets, then jurisdictional issues come into being. And these jurisdictional issues are because, securities regulations have developed globally over the last 100+ years, really to protect the little guy. And so you can't really throw that out just because you have a better way to settle, securities, right? So the idea is, operating within that realm is what I think, certainly from our point of view at Libeara, we're solving for. So the various speeds at which things operate from a jurisdiction to jurisdiction perspective will affect things for sure. But I think more and more regulators are looking at things from a more fundamental basis, right? So, it's what is this thing? It's a security, okay? Well, we used to have it on a piece of paper, and then we decided that piece of paper's my dog ate my security, so we got to put it into somewhere that can be centralized because they didn't have the technology back then to decentralize it. And so it's centralized, right? And then we have two generations of people that have gotten used to centralization. And so now we have to kind of think about, well, maybe there's a better way of doing this. But you have to remember that the world's financial system is still built around trust. I think Gabriel is absolutely right that, at the end of the day, it's not really about who has a better token or which is more interesting, but it's, finance is about human interaction and about human behavior, right? So from that point of view, making people understand that this is the same thing as a real security, making sure that you're creating securities in tokenized form and natively tokenized, such that however way you own it, you're still owning the actual thing and you're getting the right protection around it. I think these are some of the things that will give much more adoption and growth. And again, while we can't completely be borderless and have, I can't put ultra, on a bus ad in Luxembourg. But we're getting there one by one. There's and again there's a path to it, and we just have to understand how securities regulations and laws operate on a multi-jurisdictional perspective, and tread alongside that.
Yeah, no, I like that, which is essentially know the rules of the game, play within the rules of the game, play it really well, and then, we see that regulators will observe and then adjust as they see the value in that. I really like that. Talking about the ability to adjust and play within the rules, that Aaron mentioned. Maybe Peter, you can talk through what the role then of banks as well as custodians and infrastructure providers will play in working with the DeFi protocols, with the traditional asset manager issuers, in order to create an ecosystem that where RWAs will thrive. What's the role of the bank, the custodian, and the infra players?
Yeah, I mean, they will play tremendously important role, I think, because that's where the relevant users are onboarded at the moment.
Right.
I mean, of course, you can create a brand new crypto native centralized platform to attract users. That's another approach. But I think more impactful, high impact approach would be get these traditional financial intermediaries to embrace and acknowledge the benefits of tokenized assets, and get them to package in such a way that their users can easily digest and consume these more I guess more efficient and the better services, essentially. So I think they will play tremendously important role. Now, that doesn't mean that everybody's going to do it. I think everybody's going to, all these companies going to embrace the technology at their own pace. So some will be faster than others. But what we'll end up seeing, let's say 5 years from now, will be some will end up being like Blockbuster. I don't know if you guys are old enough to remember that company, but like I certainly do. Blockbuster was everywhere in the 90s. Every corner, every block in the city. Now it's it's history, right? Whereas some will, and those that will embrace the technology will end up being like a Netflix of today. So I think there will be individual differences in terms of who's going to embrace the technology first. But I think they will definitely play a very important role. So I think we hope that. Sorry, go ahead.
I was going to say, are you saying then that Web3 companies and the intermediaries need to work with these guys, or will they be able to avoid them completely?
I think no. Actually, that's a very good point. I think that's the point that I actually kind of overlooked to say. But they definitely need to work together. I think that those that can work together will probably embrace the technology faster. I mean, if you look at all the big TradFi firms in the US, for instance, that are moving faster than others, they are in partnership with many of the crypto native firms to roll out their services. There are the many that supports their the new tokenized version of their services behind the scenes. So I think it is absolutely necessary that these TradFi companies work with crypto native firms.
Right. No, I love that. And I think that's a good pathway because Sean, you're building out basically an ecosystem component, right? You're working with the blockchains, you're working with the fintechs, you're working with the product creators. So what ecosystem components are working well and what's still missing?
Very good question. Okay, I think there are two things that I wanted to touch upon. In terms of liquidity, as you mentioned, Stacey, throughout this session, distribution is everything. In any industry, distribution is everything. You might be able to create a fascinating, attractive ETF product and you can tokenize, but if you don't have demand, I mean,
Right.
it's a good test, and then it doesn't really go anywhere. If you have an amazing delta neutral strategy that you can yield like 60-70% and like drawdowns only like 0.5%, still you need demand, like right? So in terms of distribution means liquidity. I would say so far I think there's a lot of countries that are struggling, and there are a lot of countries that are progressing heavily into laying out the right foundations in terms of regulatory framework. And I guess I don't think regulation and liquidity are opposing forces. I think they come in hand. If there's regulatory clarity, it means that there's room for liquidity to flow in. People feel more secure to bring in their liquidity there. So I would say we need lesser ambiguity around counterparty risk and jurisdiction compliance. And if everything is sorted out, then I think we can progress a little bit further. And again, in terms of, because Stacey, you did mention liquidity, meaning distribution, I'd say, again, secondary utility, I guess. The reason why everybody's flowing into blockchain is because of secondary markets, and also the fact that we can collateralize these assets to create more capital efficiency. There's no reason for us to tokenize a money market fund if it's providing an additional 0.5% to maybe 2% yield, because there's added risk. There's smart contract risk, audit risk, and whatnot. But again, there is continuous advancement in infrastructure in terms of creating more secure and reliable platforms. But again, if we're able to create more utility through secondary markets, to collateralization, to providing lending and borrowing DeFi-based activities for the assets that we could not have before, then definitely these are some of the things that I think everybody's working on, and we're progressing heavily going forward.
Yeah, no, I love that. And actually, it's going to tie in really well with one of the audience questions that we have. But before we get to that, Gabriel, I think we're going to know what your answer is, but we'll give you the chance anyhow. So then, does liquidity matter more than technology?
I think it goes hand in hand. I think not necessarily that liquidity would matter more. Obviously, the technology has to be up to par to support that liquidity in the first place. But I think liquidity is more of a byproduct of demand and regulatory clarity. So I imagine a future where we get to a point where, because if you think about it and you zoom out, blockchain and crypto, at the end of the day, it's all infrastructure. And the end user doesn't really need to know how the infrastructure kind of works. If you go onto your Robinhood app, you don't really need to know how you want to trade.
I think you said the right word before. Don't really want to know.
You don't have to know. It's
that's right.
And that's where I think demand really comes from. If you have the distribution rails, if you have these platforms that operate using blockchain technology in the backend to make things a lot more efficient, then I think obviously once you have the regulatory clarity, liquidity will flow in by itself. So to answer the question, it depends.
If I may jump in here, I think, look, if you ask a common person, what's riskier, equity or bonds? A company's bond and a company's equity, what's riskier? You'll be surprised that most people will say bonds are riskier. Because people will say, oh, bonds have risk factors, and bonds are going to be, you can get stuck
have credit
with it,
ratings. The stocks don't get credit ratings.
But when bonds die, you know what they become? They become equity. So if people understand cap tables, then obviously that's wrong, right? But then it's true, because all you have to find is the next. In equities, you can operate based on a greater fool theory, right? So insofar as you can get out of it, it's risk-free for you, right? So the element of liquidity that changes the dynamics on some of these things is real, and there's no doubting that for sure. But I think we also have to look at things, from a little bit more fundamental perspective, where what is it that we're trying to solve for? We're just trying to solve for liquidity because, people want to get out of things easily, or is it because actually, people want to buy and sell it, right? So I know people talk about tokenized, real world assets. There's no liquidity. We need liquidity. We need people to trade it. But we need people to be able to access it. It's not necessarily about, I need to actively trade it and I'm going to make my little bubble of RWA trade so way above, markets such that it's going to be I'll give you an example. And this is like 10, 12, maybe 15 years ago. Many of you who've been to Singapore know where Marina Bay Sands is. And Marina Bay Sands did an issuance of perpetuals. And again, this is not crypto perpetuals, so different, but go look it up later. Anyway, so the perpetuals, and some of these perpetuals, which were retail oriented, were listed on SGX. And the institutional version of it and the retail version of it were trading at completely different prices. It's not supposed to do that. It's the same risk, but it does because of liquidity, because of access, because people want it, and it's accessible. Now, I think while utility is interesting, what can you do with it? I can borrow and lend against you. RWA is great, but I actually think that the biggest thing that tokenization brings to us is our ability to compose. Right? I want this bit. I want this bit. I want to be my own asset manager. I want my friends to copy my trade by looping these things together. This is the type of utopia where you get more control over your assets. But that's a very different proposition from what Robinhood is doing on chain.
No, that's very interesting. Yeah.
So it's, again, maybe we need another discussion on that.
But I was just gonna say,
re-intermediation. Is that what we really want?
Right. And this is perfect to segue to the question, because the question is exactly about accessibility, where you talk about, is accessibility enough? But the question we have from Naledi Moabi is, how do you see tokenization affecting accessibility to financial markets for previously disadvantaged or underserved, let's say, users? And maybe I'll turn it over to Peter and Sean, right? Looking at accessible products, right? So do you see tokenization offering better accessibility to maybe communities that might not have access to some of these products before? Oh, Peter.
Yeah, maybe I can go first. So I think in theory it should. But when you but when you try to put this in a regulatory compliant way, it gets compromised. So, for instance, I think it's been on the press. New York Stock Exchange is trying. They're likely, they're soon to be launching a tokenization platform. In the fourth, before the end of the year. But what I've learned is that the brokers that will have an access to the venue is going to have to be the licensed brokers.
Right.
Now, okay, so they're doing that because they want to be compliant. But if you end up doing that, then it's not going to improve accessibility hugely. Yeah, exactly. So, so that's the now. There's also, there's a lot of the equity tokenization has taken place offshore, and many of them are. When you look at which tokenized equities are trading actively, these are it's actually happening in the offshore exchanges, right? There are some people who think that that's not very ideal because it doesn't really represent real equity, right? These are third-party issued instruments, and maybe there's some risks associated with it, which is fine. But then when you think about why these offshore instruments are so popular, is because it exactly reaches the people that the traditional rail was not able to, provide access to, right? So I think tokenization in theory, it should be a technology that improves accessibility. But I think there's this balance that we have to work out, right? Like if you really want to bring the benefits of tokenization, there has to be some improvement with our current regulatory regime. Otherwise, we'll end up compromising just a lot that there's no point of tokenization.
No, I agree with that. Go for it, Sean.
Yes, I basically agree with everything that Peter said. But I want to take a stance of a contrarian a little bit. Peter, let me
Oh,
move
there
this.
we go.
For example, like you've seen in this frenzy of semiconductor AI a boom that we saw in the past maybe 6 months to a year. The global market was had a strong demand in terms of like Korean semiconductor stocks, including, as you know, like SK Hynix and Samsung Electronics. But as you know, they do not have access to these stocks, and somehow they kind of managed to. I mean, some of the platforms did tokenize these stocks, and later on we had the ADR for SK Hynix. But at the same time, still, like the local Korean stocks somehow got into the hands of people that initially they wouldn't have access to. I am not a legal expert to see like if this is within the boundaries or not, but still, tokenization and blockchain does enable access to which was initially not reachable to the demographics of people that enables them to do so. And sometimes, like for example, like what I see is that there's over like $20-30 billion of tokenized real world assets on chain as we speak, and most of them are, I would say, and a larger portion is in stable coins, but still a lot of these traditional assets, even if you tokenize, do have the same characteristics, meaning that you need to do KYB, you need to be an accredited investor, you need minimum order quantity of maybe like 500,000 to maybe a few $1 million. But at the same time, there are mechanisms where you allow permissionless structures for these assets, that if that's the case, it good. So in that case, then it would reach the hands of the retail population initially, which would not have able to do so. But in terms of, I would say, Peter, this is more on a technicality of it. But again, there are implications, jurisdictions, regulatory framework again. But I think it is a technology that would enable these features going forward. But I do 100% agree with you that we need a regulatory framework to allow these to be operating and within the scope of any jurisdiction, geopolitical, geographical restrictions as well.
And I definitely think, as Aaron mentioned, this could be a much longer discussion, right? We can even talk about some of the IPOs, right? The pre-IPO tokenization platforms and how that, grew and then crashed before the IPOs, and, what are the implications of building these kinds of products. So I like that, Sean, in terms of taking that viewpoint away. Okay, last question is to Gabriel from the chat. And then for the other gents, think about your 30-second answer to what are you most excited for in the next 1 to 2 years for your company and for RWA. So Gabriel, your question comes from Mike Yu from Orca, which is the leading DEX on Solana. So they are asking, what does it actually take to get institutional grade secondary liquidity on chain, and who should own that problem? The issuer, the market makers, or the venue? I think this is a perfect question for you given Securitize's role.
Yeah, for sure. That's a very interesting question. And I think maybe to zoom out a little bit, when we talk about liquidity, especially for things like tokenized equities, the biggest markets in the world, NYSE, NASDAQ, these are the places where you can source the most liquidity. And creating secondary liquidities for like 1,000 stocks on chain is just not viable and not scalable. There's no way you can provide a user-friendly experience without very high slippage. So I think there's probably a couple ways to achieve this, right? Is for us, how we are doing it is that we want to be able to essentially link these markets. If let's say, for example, someone buys a tokenized stock on Orca, for example, at the same time we are purchasing that stock on NYSE or NASDAQ or one of these like major traditional exchanges. And at the same time, we atomically mint the equivalent stock on chain and provide that to the user immediately. So effectively, what you're getting is instant, or not really instant settlement, because stocks themselves kind of settle on like a T+1. But you get instant access to these assets that can live on chain.
Yeah.
So the issue then is, okay, what about off-market hours? Who takes that risk on the weekends? So I think that's where we can sort of bring in other parties like market makers or firms that operate or provide this service for overnight or off-market hours, and then we can provide that quote to the end user. If the quote does not sort of meet what the end user is looking for in terms of like a spread, then we would try our best to fulfill that order. If not, then that order would obviously fail, because then we want to provide like a better experience for the end user. So in essence, I think we want to be able to link these two markets in a very seamless and scalable way without fragmenting liquidity on chain.
Yeah, no, thanks for that. And the market makers are always happy to hear that for a price. All right, so 30-second summary. Aaron, what are you most excited for?
I'm really excited for the building out of the credit curve, if you will. I think RWA started out with treasuries. Now there's multiple income products. We have a Wellington managed income product that is yielding early to mid 5%. We're looking at launching something that is going to yield more than in that region of 10 to 12%. So again, I think Sean was mentioning something that is in the in the low teens as well. So a lot of these activities in terms of broadening out that investor horizon. I'm very excited to see how that all works out.
Fantastic. We're excited to see those products also on Utila. All right, go for it, Peter.
Yeah, we're generally excited about all the tokenization related opportunities in Asia, but Korea in particular. Now, the reason for that is, if you in East Asia, I think what many people don't realize is there's only less than 3 jurisdictions where capital market is completely open. These are Japan, Hong Kong, and Singapore. The rest of the countries all have some sort of a capital control. Despite Korea being maybe 10th largest economy in the world, the currency regime is very, very restricted. Now that's going through some change. This is actually, you can look up some articles on this on Bloomberg, but for some reason not very widely reported. There is works that are being undertaken right now at the government level to allow offshore trading of a Korean won starting from January next year. So what that's going to enable is the Korean won is not going to be restricted currency anymore, and it'll be, it won't happen overnight, but it'll gradually look very kind of very similar to Hong Kong or Japan in terms of the capital market openness. So I think that's going to allow far more interesting opportunities in terms of what you can do with the tokenized assets, because one of the benefits of tokenized asset is that it's going to be a lot easier to move cross-border, and I think there's going to be a lot of related interesting opportunities coming out of that huge change that Korea is going to go through at the beginning of next year.
We look forward to the creativity coming out of the market after that happens. Awesome. Sean, go ahead.
Resonate 100% with what Peter said. Like, I'm extremely excited with the Korean market, especially because of everything that Peter said. And at the same time, just want to emphasize that there's going to be stablecoin initiatives that's going to be deployed, and capital control, which was heavily restricting a lot of financial activities, especially in the global space, is going to be, there's going to be a huge lift. And also there's a lot of, because of geopolitical issues, there has been a lot of suppression of the company value, especially in the holdings companies, that I think we should really look into. But again, Peter has touched on all the ideas, but like my initial discussion that I wanted to focus on was AI, especially on our platform. There's going to be a lot of enhancements in terms of risk curation, or what you call like asset management in terms of the blockchain space, that we're going to see vastly enhanced because of the AI curated strategies. There's a lot of financial knowledge that you need in order to manage a vault or an ETF or any type of asset. We're going to see a lot of enhancement in that field, especially because of the sophisticated support that AI is going to bring in terms of setting the right risk parameters, and also doing a lot of financial analysis on the asset itself, and also the underlying asset evaluation and many other factors. So I think a lot of the retail population will be able to kind of act like a financial expert in many fields. So there's going to be a lot of wise decisions that the retail population will be able to make at the level where all these CFAs, FRMs, and all these financial professionals were able to do. So this is an area that we're going to be able to see.
Love it, love it, love it. All right, Gabriel, close us out. What are you most excited for?
Honestly, I think what we are most excited for at Securitize is being able to bring tokenized securities and equities on chain in a fully compliant, legal, and scalable way. So how we're doing this is with one of our largest partners, Computershare, which is the biggest transfer agent in the world, and also Continental. So they basically enable us to tokenize 60 to 70% of the S&P 500. So think of the Mag 7, think of AI companies, think of Teslas of the world, Nvidias of the world, and being able to bring this on chain in a fully native way with legal representation of the shareholders as well. So you as a shareholder owning the stock on chain, it would be the equivalent of owning the stock on a traditional brokerage. So I think that's something that is super interesting to us, and we're really looking forward to it.
Awesome. Thank you so much, gentlemen. We really appreciate the insights that you've shared with us. We know that each and every of your companies are really making waves and being pioneers in the industry. For everyone online, if you want to work with their company, reach out to them. They'll be very happy to form new partnerships. We're very excited to be working with you guys and also having you as customers. Thank you again, and we look forward to the next webinar series. Thank you for the questions as well, and have a great day or evening wherever you're listening in from.
Thanks so much.
Thanks, everyone.
We'll see you again, Stacey-Ann. Take care.
Thank you.
Thank you, gentlemen.